Let's discuss the risks associated with equities. If you go back and revisit our first chart where we talked about the returns for investing in equity markets, the chart is very similar to the chart we can see on the left hand side, where you will see a lot of ups and downs when you invest in a equity stock. Whereas when you put money in a fixed deposit, you expect to earn a fixed return over a period of time. Whether a company does well or not, you would want to get your 7%, 8% without any upside and with an expectation of nothing on the downside. But when you invest in an equity stock, you are willingly investing to participate in the upside as well as the downside of the company. So the variability in returns that you will get by investing in stocks, both in terms of the stock appreciation and in terms of the dividend that you will earn, is going to be very high, and you should be prepared for that before you decide to invest in a equity stock. Let me introduce some technical terms here for you so that you start getting a hang of the language you must be talking when you're talking about equity stocks. Because one objective of this session is, by the end of this session, we want you to start gossiping about stocks just like you gossip about, say, Hollywood or Bollywood. So two major risks associated with investing in equities is systematic risk and unsystematic risk. Though these words are pretty fancy, let me break them down for you to understand. Systematic risk is basically the risk which is associated with investing in the markets as such, or it is the risk which the entire market is exposed to. Whereas unsystematic risk is the risk which is associated with investing in a particular company or sector. If you take the example of how various companies have been affected because of the COVID pandemic in 2020, in the month of March, every company, irrespective of what sector they belong to, irrespective of how good the company was or how bad the company was, how well they performed in the past, every company was affected and everybody had lost close to about 30% of their value in the month of March because they were exposed to a systematic risk which was in the form of a COVID pandemic hitting the market, right? So when we refer to systematic risk, we are largely talking about the geopolitical risk or the economic risk, which irrespective of how good or bad company you are, you will get affected by this risk. Unsystematic risk is the risk that affects only a particular company or an industry. To give you an example, if you look at the cigarette industry in India, it is constantly known for being targeted by the government because they do not want to encourage the consumption of cigarettes. They constantly keep increasing the taxes that apply to this particular sector. So each time the government increases the taxes, it has an impact on only that company or that industry which is being affected the most. So unsystematic risk is something which is localized to a company or an industry, whereas systematic risk is which is going to hit the entire market irrespective of who you are. Naturally, systematic risk is something which is external, whereas unsystematic is an internal risk. Another example of systematic risk is when the interest rates go up. If the interest rates go up, then it becomes expensive for a company to borrow, and that becomes expensive for any company, how good or how bad you are. When overall the trend is high interest rates, it's going to impact all the companies trying to go and borrow money from the market. Whereas something like a business risk, when a business is not being handled well, right? When it is not managed well, when it is not executed well, that is something which is specific to a particular company, and that is unsystematic risk. So a Reliance Power is today valued at 1% of its original price because of the unsystematic risk of the management not being able to execute those projects and deliver, and that was a business risk which they had. And that is why today the shareholders have lost money in that particular stock. So that is something which is specific to only that company, whereas there are many other power companies, be it Tata Power or others, who are still doing well today. How do you manage systematic risk is by ensuring you have proper asset allocation across the various asset classes, versus how do you manage unsystematic risk is through portfolio diversification. So by ensuring that you don't have all your eggs in a single company, you have not invested all your money in, say, Reliance Power. Had you put the money across a larger set of companies, if one company goes bad, because of the business risk associated with that company, you are able to kind of diversify your portfolio and manage your unsystematic risk. Systematic risk is something which you will always be exposed to, because once you invest in the market, you will always have the risk of the market variability coming and hitting you. Just like if you take your car out, you can be an expert driver, you can take all the precautions in the form of a well-serviced car with airbags, etc. But you always have the risk that there can be a small chance of an accident happening. You can be well prepared for it, so that if it were to happen and hit you, you are able to tide through it. In the same way, when you're exposed to the various factors which cause systematic risk, whether it is a political factor or economic factor, asset allocation ensures that you are well prepared to take that loss and you're able to manage it well, because you are not over the board in any particular asset class. An example of the systematic risk is the 2008 market crash. Irrespective of which company you were, what segment you belong to, what sector you belong to, what industry you were in, all those companies were affected when in 2008 the markets crashed, and the result was a loss or a sea of red across all the companies you can think of in the equity sector. Whereas when we talk about the unsystematic risk associated with investing in equity, it is that risk which is specific to a particular company. So business risk is basically the company not being able to manage its business well, right? When you invest in a particular company, you are investing in the future profits of the company, and those future profits will get realized only when the company is able to execute on its vision and transform its plans into action, and that is what gets translated in the form of profits which you enjoy as a shareholder. Another example of unsystematic risk is a risk which is associated with high use of debt by the company. So if there are two companies in a single industry and one company decides to use a high amount of debt to able to fund its operations, then if the cost of debt goes up, or if for some reason, say like the pandemic hit and there were no sales, but the company was obliged to repay the people from whom it had taken a loan, then the company is hit by an unsystematic risk of having too much debt in its balance sheet, and that can have a huge negative impact on the overall performance of the company. That is why it becomes important to have a good understanding of the various risks associated with investing in equities and ensuring that you are well prepared to manage those risks as and when those events hit you, which can have an adverse impact on your portfolio. Now that you have a fair idea of the kind of returns that you can make by investing in equities and the varied kind of risks associated for investing in an equity share, let me make a small attempt to answer the most widely asked question of how do I select an equity stock? I think this is the most difficult question that can be asked to a financial advisor as to how should you select an equity stock. The reason being that the stock markets or your investments in an equity stock are exposed to a varied of factors, some which can be anticipated and many which cannot be anticipated. And these are factors which are being analyzed by thousands of analysts all across the world, and each of them coming up with their own interpretation of how these factors will affect a particular company, and all of them assigning a very different future value to the company based on what they expect the company should perform. And these expectations are being translated into trades by millions and crores of investors who are doing trades of buy and sell on a regular basis, because their expectations keep changing as the economic factors which you would expect to affect a company, one, the factors that affect a company change, and second, the intensity which these factors affect the company also keep changing on a daily basis, on a very dynamic basis, because of which the share price of the company changes every day. Every day different analysts are coming out with different understanding of the company and trying to assign a value to the company, which is resulting in a lot of trades being done by investors who are following their respective advisors or analysts, and that is in turn showing up in the share price of the company. While it is a subject topic of a complete 15 or I would say 150 hours course to talk about how you should select an equity stock, let me give you the extreme basics in the form of the three most important factors that you must look at when you decide to buy an equity stock. What are these three factors? The first and the most important factor when buying an equity share is do you understand the business of the company, right? Because what you're doing is you're betting that a particular company is going to do well, and that is when you're deciding to buy the stocks of the company. So you would want to invest in a company only when you understand the business of the company. If you look at a company like Coke, it is easy to understand the business of the company because they're selling products which are visibly available everywhere, and you keep a track of how well the company is performing based on how much of its product they're able to sell. Same thing goes for a company like Apple, wherein you can easily understand in terms of how many products got shipped, how many got sold, so what should be the profit of the company. If you pick up a company like a pharma company which has an extremely complicated business in terms of the R&D they are running, the kind of products that they have in the pipeline which you and I may or may not understand, the kind of markets they're selling the products to, their exposure to foreign markets apart from their exposure to Indian markets, the various products in pipeline, the different research stages they are in, the actual impact that particular product can have on curing a particular disease. When you don't understand a particular company well enough, you may want to think twice before putting your money there, because you put your money and for some reason an inspection happens of that company's facility in India and the prices go crashing and you're wondering exactly what went wrong. So the first and the most important factor you must look at when you're buying an equity share is you need to understand the business of the company, so that, broken in a simple term, you need to know how exactly the company is making money. If the company is making money selling Coke bottles, how much does it make when it sells a Coke bottle? If a company is making money selling iPhones, how much money does the company make when it sells an iPhone, right? So once you understand the business, you are able to relate the various factors associated with the company, various market movements that happen, and take a call on, is it something which is positive for the company or is it something which is negative for the company? So when Apple is able to sell more of its product in a new market like India, which it was never been able to sell for the past many years because of the high cost of the product for a country like India, you realize that when they set up a plant in India and are able to sell products at a comparatively lower price than in the past, and that is increasing their sales, that is where they're seeing an expansion in their market, and that should do well for their market price. But when you look at the overall contribution of a country like India in the overall sale of Apple, it is still very minuscule. But what is promising is the factor that they are growing at a pretty good rate in India compared to other countries. All said and done, understanding the business will help you take a decision on when various market factors move, when various systematic and unsystematic risks change with respect to a company. You understand exactly how much they are going to impact a particular company. The second most important factor is the ethics of the management and the executional capabilities of the management. This you can see by looking at the history of the management. If I were to give this in the form of examples, if you look at what happened to an HDFC Bank versus a Yes Bank, both were considered to be the darlings of the stock market about 3 to 4 years back. And for the last, I would say 8 to 10 years, both of these have been giving fantastic returns. But eventually, Yes Bank hit a wall and the share price of Yes Bank fell by 80-90%. Its management had to be changed. RBI realized that they were not providing for loans well enough. There were a lot of gaps in the management of the company. There were a lot of gaps in the balance sheet of the company. It resulting in where it is today, where it had to be bailed out by some of the other banks. Right? Both HDFC Bank and Yes Bank had a very promising future, had a very promising business setup, right? But where they differed largely was in their management. One, the ethics of the management, and second, the executional capabilities of the management. That is where Yes Bank lacked, and that is where they lost. Even the earlier example we discussed about of Reliance Power came out with an IPO asking money for setting up the largest power generation project in India. But if you go back and look at their history, the management did not have the executional capabilities. They did not have the background or a history of having delivered on projects of even half the size. When they didn't have the executional capabilities, betting on such a company actually going ahead and setting up and delivering profits on such products was going to be a tall task. Executional capability of the management combined with the ethical background and the ethical history of the management plays an extremely important role in helping you determine whether you should buy a particular stock or not. The third important factor when you look at when you're buying an equity share is what is the price that you are paying to buy that particular company. This is something which cannot be ignored, and this is something you should relate to your day-to-day purchases. Today, when you go and buy a product from your Kirana market, you want to be paying a fair price for it. You can decide to buy a soap which is worth 10 rupees or which is worth 100 rupees. But when you buy a soap which is worth 100 bucks, you know that you're getting that much value from it, or it has a certain chemical mix which is good for your body, and that's why you want to pick it up, versus buying a soap which is worth only 10 bucks. It is the same as whether you walk into a hotel which is a 3-star hotel, you pay a lower price. For a 5-star hotel, you pay a higher price. Similarly, when you buy companies which have been showing a good amount of profitability for a long period of time, which have a fantastic management, you would be willing to pay a higher price for such a company compared to some other company. But even when paying a higher price, you do not want to be paying an exorbitant price, right? For example, if you are in a city like Bombay, a 3-star hotel is going to cost you about 5,000 to 6,000 rupees for a night, whereas a 5-star hotel is going to cost you about 10 to 12,000 rupees for a night. If a 5-star hotel is available at a price of 40,000, 50,000, you may want to put a question mark on, is it worth paying so much for a night in such a hotel? In the same way, when you look at buying a particular equity share, it is important for you to pay attention to the price that you are paying for buying that small portion of the business, because if you overpay, you are never going to make returns from that particular company. With this background on the factors you must look at when you want to buy a particular equity share, let me take up some examples to simplify things for you. If you look at Indigo, which is owned by a company by name Interglobe Aviation, it is a company which is in the business of flying people from one place to another, and it is technically a low-cost carrier. Low-cost carrier meaning they do not have frills. They are in the business of flying people from point A to point B at the cheapest price possible. A question which many people actually ask is, why doesn't Indigo have a rewards or a loyalty program? If you remember, when Jet Airways was operational, its loyalty program was something which many people went for. And today, many of the full-fledged airlines, being a Vistara or Air India, all of them run loyalty programs. But Indigo, in spite of having the largest market share of aviation passengers in the country, it does not have a loyalty program. It may seem odd as to why Indigo does not have a loyalty program, but when you go and talk to their management, it's very clear for them that they are in the business of transporting people from point A to point B at the cheapest price possible. That is the business they are in. They're not in the business of running a loyalty program. What they feel is that with a good network size, that is giving their customers an option to fly across different times to different cities, right, and ensuring that they are punctual, they will get their customers. They don't need a loyalty program to get their customers. And if you go back and think, when you are flying, what is the most important factor you're looking at? The reason you're taking a flight versus going by road or rail is because you want to save on time. And to ensure that you save on time, you want to ensure that your flight takes off on time and lands on time. And your first choice of taking a flight would be based on its punctuality. And that is exactly what Indigo delivers to you. And that is why they have become the largest carriers in the country today. And even when the COVID pandemic hit, this was one of the rare companies which had enough cash reserves to be able to sustain COVID and the months of low operations. So instead of trying to copy the competition and trying to come out with a loyalty program, Indigo has done really well to stick to its core business of flying people from point A to point B at the cheapest price and flying always on time. And that is why they've become the largest flight carriers in India. Let's look at a completely different industry in the form of soft drinks. If you look at the soft drink industry, Pepsi and Coca-Cola occupy or kind of enjoy close to 70 to 75% market share of this particular industry. Compared to the previous example we took, whereas the aviation industry is considered to be a highly intensive industry in terms of the competition from various players, because of which no flight operator is able to actually increase their prices beyond a certain amount, because there are a lot of competitors in the market, and if you try to push your prices up, nobody's going to buy your tickets because there are others at a lower price available. Versus you come to this industry of soft drinks, it has been largely a duopoly industry. Duopoly meaning there isn't much competition from Pepsi and Coke. If you look at if you walk into any Kirana store, walk into any restaurant, you will find that the entire shelf space is occupied by Pepsi and Coke and their products. So Coke has a range of products, Pepsi has a range of products apart from the drinking waters that they sell, and they kind of rule the industry. Now there are multiple reasons why they've reached the place where they are after the years of investments in marketing, that they've been able to get their brand recall and being able to capture the shelf space in the Kirana stores. Since Coke and Pepsi are part of an industry which is largely a duopoly, it works a lot to their benefit because they don't have to struggle for sales every day. Obviously, Pepsi and Coke have to keep innovating themselves, come out with good products, sell the products to their consumers and keep them happy. But having said that, by being in a duopoly industry, they do not have that much competition, and that makes their life that much easier, and it makes these stocks that much more attractive for you to buy as an investor, because these guys are in a duopoly industry and they do not have that much competition from other players in this industry. From Coke, let's move to a completely different business of the NBFCs, which are known as the non-banking finance companies. NBFCs typically give you loans so that you can use the loan to either buy yourself a home, buy yourself a car, use it to grow your business, or even to purchase the next mobile. Let's focus on that segment of NBFCs which lend you money just to buy your home. Let's just look at that segment. The reason I'm saying is, if you were to think as an investor, if you look at 4 NBFCs, all 4 of them in the business of giving loans to allow their customers to buy their dream homes, what do you think can be so differentiating of one business to another so that you would want to prefer a particular company? If I just take the example of Canfin Homes Limited, which is an NBFC which gives you loans for your home purchase, they have given a return of almost 29 times of your money in the last 10 years. The reason they've been able to do so well is, yes, they are in the business like any other home finance company of giving loans for you to buy your house, but they have focused by giving smaller loan ticket size. So compared to an HDFC, the average ticket size of a Canfin home is much smaller. Second, they focus largely on salaried employees to give their loan. So when they are scouting for customers, they prefer a target audience of salaried people because they know that salaried people love their homes and will not default on their homes at the risk of losing their homes, and as a result of which the NPA of something like Canfin Home Loans is much smaller than its industry, and that is because of the culture they have developed in terms of, one, giving small ticket size loans, and second, focusing on the salaried individuals so that the overall losses they would expect in terms of defaults are minimized, and they have a very good repayment culture among all their customers, resulting in higher profits for the company, and that in turn resulting in higher returns for you as their investor. The reason for taking up these examples were to give you an idea of how you can start thinking on lines of what equity shares you want to buy. Start analyzing the business, start looking at why a company is making profits, why a company is not making profits, and once you understand this, you will be able to start applying your mind to, is the company worth buying or not? As I said, first thing you need to do is understand the business of the company so you know exactly how the company works and how is it making its profits. Look at the background of the management of the company to understand that they have the executional capabilities and they are of a good ethical background, so that they are not going to make short of your money and they're going to deliver the returns that you invested in their company for. And the third factor when considering equities, look at the price that you're paying for buying a particular equity. If you land up overpaying for a company, it may be a fantastic company, but if you overpay for it, it's going to be a long period of time before you actually see any kind of returns for your investment in a good company for which you overpaid. Another factor which you need to look at when investing in equity stocks is the size of the company. We've discussed about the fact that equities are the highest risk, high return asset class, but within equities also, the size of the company determines how much risk you're taking. Basically, the size of the companies is divided between large cap companies, mid cap companies, and small cap companies. Let's look at each of them. Large cap companies basically refer to the top 100 companies by their capitalization. So if the entire market were to be put in the order of the companies in terms of the size of the companies, the top 100 largest companies qualify as large cap companies. The next 150 companies, that is company 101 to 250 by its market capitalization, these are the companies which qualify as mid cap companies, and all companies after the 250th company or from 251st company onwards, they are called as small cap companies. To give you an idea, Reliance Industries Limited is a large cap company and it had a market cap of 14.53 lakh crores. Versus if you move on to Bata, which is a mid cap company by size, it had a market capitalization of 18,100 crores. You can already see the difference between the size of the large cap company versus the mid cap company. Versus you move on to PVR Cinemas, which is a small cap, it has a market cap of 2,659 crores. These are all numbers based on the traded values on September 21st, 2020. The market capitalization of a company, which is nothing but the total number of shares multiplied by the share price of the company on any particular day, changes on a daily basis because the share prices change every day. But this gives you an idea of what a large cap, mid cap and a small company would look like. Now, why it is important for you to understand this is the risk and return of a large cap company is lower than the risk and return associated with a small cap company. Let me explain this with an example. If you look at State Bank of India, which categorizes as a large cap company, it has close to 24,000 branches in India today. Versus if you look at AU Small Finance Bank, which is considered a small cap company because of its size, has only 400 branches in the country. Now, if you were to put your money in a company like SBI, State Bank of India, do you think the company can double its profits in a year? And if doubling profits requires it to double the number of branches or even increase the number of branches by 50%, do you think it's possible? The company is so huge that it cannot double in size. It is already way too large. It is going to grow at a steady rate, but doubling in size, it's a big question mark. Versus an AU Small Finance, which has only 400 branches, if it wanted to double in size, can it double its branches to 800? Yes, it has been done in the past and it can easily double its number of branches in a year or maybe in 15 months to 18 months. So if AU Finance is able to double its number of branches, double its lenders and borrowers, double the amount of money they're able to give out, they can actually double their profits and expect their share price also to double. But at the same time, do you think an SBI can shut down overnight? If there is any risk in the market or if a systematic or unsystematic risk hits the company, do you think SBI can shut down overnight? No, SBI is way too large a company. It has enough size in its balance sheet to weather all the kind of risk and it will not shut down overnight. Versus the AU Small Finance Bank, which is still a very small bank, the chances that it can shut down if an event were to hit it and it does not have adequate capital to face the market risk that it is exposed to, the chances are much higher there. It can be a well-run bank, but if you were to do a comparison between the two, AU Small Finance is a small cap company and is associated with high risk, high returns, whereas SBI comparatively is a much larger company, and compared to AU Small Finance, you would expect lower risk and lower returns when you invest in SBI. So when you invest across various stocks, an understanding of these parameters helps you gauge the amount of risk that you're taking when you invest in a particular